My name is Scott Mercer, and I'm a partner with Palmer & Kay here in Charlotte, North Carolina. And I'll be our moderator today for our webinar entitled Partnering with Owners to Turn Insurance Expense into Equity. Now, just what do we mean by that catchy title? Well, today we're going to share with you some principles that insurance companies use to turn premium into profits for their shareholders. And we're going to use those same principles to the aggregated risk exposures of mid-market companies through a group captive strategy, converting premium to profit, i.e. equity, for the business owners who participate as captive members. And we're fortunate to have with us today Nicole Kolaluca and Peter Enyart of Captive Resources to lead our discussion today. Captive Resources is the largest group captive manager in the U.S., having created and actively managing more than 40 captives for the benefit of those captive members and business owners. Now, Nicole will be leading our discussion on how group captives work operationally, and Peter will be sharing his thoughts on captive tax and investment issues to round out our presentation. We'll be collecting questions from our audience during the webinar, and we'll have time for Q&A at the end of the presentation. Before we get started, I just want to give a brief introduction on Palmer & Kay. Palmer & Kay is a commercial insurance brokerage firm providing risk advisory and insurance brokerage services and benefits for our clients. We're a private, family and partner-owned firm focused solely on the mid-market. We have risk expertise across multiple industries and are obsessive on leveraging data and analytics to drive our advisory, loss control, and claims management services to reduce our clients' total cost of risk. We also pay particular attention to addressing the executive risks of our private clients, as they seem to be underserved risk exposure in the private mid-market sector. As most of our colleagues come from big box global brokerage houses, we are all drawn to work in a boutique private platform where we believe we can better cater to the needs of our clients. Due to our experience at the highest levels within industry, we like to think we bring Fortune 1000 level sophisticated risk advisory and insurance solutions to our mid-market clients. I'd like to think that our webinar today is a prime example of that thinking, and hope you will too. That being said, I'm going to pitch the ball to Nicole and Peter to take over from here, and I'll be back at the end of the presentation to help moderate our Q&A. Nicole?
Hello, everyone. You can see me. Let's get this moving. Here we go. My name is Nicole Kolaluca. I am been at Captive Resources for 5 years, and I'm a captive exec here that manages 2 group captives out of our 42 at the current moment. As Scotty said, we are the largest group captive consultants in the United States. We like to say world, but most of the group captives are outside here or in the Caymans or Bermuda. We represent over 4,900 shareholders. That's 4,900 companies here in the U.S. Best thing about this, you can go through this. We can educate you on this. That is our job. We want to be very transparent to you on what this is going to be for you, but there's 4,900 companies out there that you could actually talk to. Every single one of them would love to pick up the phone and talk to you about the captives, especially if they're in that specific captive that you're interested in. We have a combined premium of over $2.7 billion. And then we also have the Captive Investors Fund. So when you think about conventional insurance, they take your insurance money and, the AIGs of the world, we all know what happened in 2008. They had bad investments. But what the insurance companies really do are making money off investments year over year over year. Well, why don't we do the same for you? So what we do is we take your insurance premium and we invest it with all of the captives that we have in a captive investors fund, which is now $5.2 billion. Peter will be walking you through the specifics of that investment at the end of this presentation, But think about it, when we talk about the investment income on your return, it is all coming from that captive investors fund. So today I want to specify that we will be going through Spartan Insurance. Spartan is one of the 42 group captives that we have here at Captive Resources. It was started last year, February 2019. It is a heterogeneous captive, so it isn't dominated by one industry. We have construction, we have service industry, we have warehouses, distribution, transportation, manufacturing, retail, all within one group. So it gives that spread of risk through each industry. Right now, there's currently 30 members with a total of $5.8 million. The minimum premium to get into Spartan is $100,000. So the $100,000 is for your general liability, workers' comp, auto liability premium. Every captive has different minimums. However, all of our captives are pretty much structured and managed the same way. So everything that I'm going to go through, even if Spartan isn't a fit for you, the other captives are very similar. They may have just a little bit differences in minimum premiums and effective dates. As you can see, the renewal date for Spartan was 5/1. It goes from 5/1 to 4/30 every single year. So joining the captive, all your 3 lines of coverage will renew at the same time as the rest of the other members. What are we talking about today? What is a group captive? It's an insurance company that provides insurance to and is controlled by its owners. The biggest thing to take in, and we talk about taking in equity and investments, you are going to be not buying insurance in this scenario. You are going to be owning an insurance company. You will be a director and owner of Spartan Insurance with 30 other members. And those members are business owners just like yourselves. We understand that this isn't going to be your main operation of business. That is why we have Captive Resources and our sister company, Kensington, to help you manage the company. And we bring and we meet twice a year at board meetings so the members can vote on how the company should be functioning. Any changes, renewals are all approved by you, the owners. There's multiple different types of captives out there. There's the single parent captives, Fortune 500 companies, the Googles, the Pepsis, all of the Coca-Colas. They're all single parent. Basically, the IRS is looking at them as a self-insured retention. They're self-insuring themselves to a certain point, and then they're stacking on reinsurance on top of them. They can't write off 100% of their premium because they're self-insuring. The other thing is they still have to worry about claims from 10 to 20 years ago because there's no carrier out there that's going to want to buy what we call is their tail. Then you have rent-a-captive and agency-run captives. They're very similar, and the space is basically rented by the members. The ownership is not with the members themselves. The ownership is with a rent-a-captive in this scenario would be a carrier. So you would be renting the captive concept, but AIG would own it. Or the agency is you'd be a member renting the space or renting a spot within the captive, but the broker agency or consultant agency actually owns it. So the investment side doesn't go 100% back to the members. Now, when we get into the group captive, the IRS looks at a group captive as an insurance company because we have risk sharing. Just like AIG, just like all the major corporations, Zurich, CNA, Old Republic, Travelers, they all take your insurance money and they bundle it up with that underwriter's book of business. And so when you think about the risk sharing that you see in a captive, you're doing the same thing you're doing now. And what you are able to do, if you have a guaranteed cost policy, you can write 100% of that off as a business expense. The same thing with the captive. The captive premium is a business expense because it is an insurance company. There's no self-insured retention within a captive. All of our captives have a mechanism to close out years. So we have 3 ways to do that throughout all of our captives. On average, it's anywhere between 5 and 8 to fully close out. The construction captives normally wait longer because the general liability has a longer tail. But ideally, at the end of, you've been in the captive 5 years, that first year you can close out. You don't have to worry about a claim that happened 5 years ago. We also have the homogeneous and heterogeneous captives. Today I'm talking about hetero, which is Spartan. We have homogeneous captives that are industry specific. So we have Wildcat, that's oil and gas. We have Wheels, that's long haul transportation. There's always a home. Normally if a heterogeneous can't take that within their appetite, we have a homogeneous that can. But like I said, they're all structured the same way. All the captives work in this, they all run the same way with all of the insureds are the owners. Again, 100% of the ownership goes back to you after the proposal. So we go through this extensive underwriting process. Palmer & Kay puts a submission together. We go through it. We have an outside actuarial that gets a loss pick. We add on the operation cost. That's your premium. We sit down and we go through the numbers. First thing you're going to do, if you want to bind, you have to buy your ownership, correct? So you have to purchase your shares within the company. That gives you that one equal share amongst all the members. And that's a common share. That's $100. But then you have to buy a preferred share. That's $35,900. That preferred share is where the distributions come back. Peter will be going into that when we go into the finances. But that $36,000 is what is required up front to give you the ownership in the company. That does not go away if you ever leave the captive. That is your money that you still put on your financial statements. 1 vote per member. So we may have a member that's $6 million in premium, but we also have a member that's $100,000 in premium. That $6 million member does not have more ownership than that $100,000 member. It is equal shares amongst all members, equal vote at the board meetings. The best thing and the most critical aspect of this is risk management and claims. Because if we can control the losses and control how the claims are handled, and we could drive that down, well, guess what? Your premium's based off your losses. So that way we can drive down your loss costs, we drive down your loss funds, drive down your premium, and the end goal here is that you pay in what you need. So the whole captive concept, because you as the owner, we're all working for you. This isn't based on class codes. This isn't based on state rates. This is based on your performance for 5 years. And every 5 years, we do an updated 5-year loss pick. We talked about the board meetings. Everybody goes. It's not mandatory. Some captives may have a pre-funded amount. If you go, you get X amount of money back. If you don't, it goes to the other members. However, it is important for you to attend. There are 2 board meetings a year. All of our captives are domiciled outside the United States in Cayman Islands. So all the meetings are outside the United States. We do all business, conducting business for the captives outside the U.S. So we don't have trade or business in the U.S. So we have no investment income tax on all of our business that stay in the Caymans. We also, so those meetings for Spartan are going to be April and October every year. April is renewal meeting, October is midterm meeting. Normally the midterm meeting is when we start talking about closing out years and giving distribution back. Obviously in April, we talk about how the renewals are going. You get your renewal pricing and you yay or nay vote for it. We do have a committee structure. We have a president, we have a vice president, a secretary, finance committee, underwriting committee, risk control committee. You can be as proactive as you want to be. We will provide you multiple data to say the members that are more proactive have better loss ratios and better premium. However, it's completely up to you. If you don't want to be present, you don't have to be. It's basically a volunteer job. But you can be involved as much as you would like. The Cayman Islands, there's multiple reasons why we're down there. The one thing, again, I mentioned earlier is the corporate income tax. There's no corporate income tax down in Cayman. When we started the captives, there was Vermont, Bermuda, and Cayman. Cayman was just easier to do business. We all do business in the United States. The regulatory requirements in Cayman, we were able to get captives started within a couple months. In the US, it's a little bit harder. There's 10 times more paperwork. You got to go through state and then federal. It's just a lot smoother to do business down in Cayman. The biggest aspect, and Peter will go through it, is that captive investors fund. It is domiciled in the Caymans. It gives us a little bit more flexibility on how we invest the money. So let's just talk about how a conventional guarantee cost policy works. As you may have read, that I was an underwriter for 5 years with AIG and Chubb. So you can see that I knew what happened on the back end. So when you got your policy, you see a premium on there, you really don't know how the breakout of what is AIG getting? Where does this money go? What are the class codes? The class codes are just telling you that this is what your premium is. On average, that carrier is taking anywhere between 40 and 50% to pay for operational costs, paying the underwriter, the staffing, the policy issuance, the actual paper. But what happens? Let's just say 50% goes to operation costs. What happens to that additional 50? And you had 0 losses that year. What happens is AIG or Chubb will invest that money, and they just have that 50% of underwriting profit, and then they have additional investment income that goes directly back to them. And you don't see that aspect. Well, within a captive, our operational costs for Spartan are 36.28%. And you will see that on your proposal. I break it out by line item. You will see what the paper company Old Republic is. You will see what the third-party administrator, the claims handler will get. You will see what we put aside for the board meetings. All of that is broken down into 36.28%. Well, what happens with the rest of that money? That's your money. You are the owner. You get that money. We invest it in the captive investors fund, and the return goes directly back to you. Captive resources fee is within that 36.28%. The broker fee will be broken out. Everything will be as transparent because you are the owner. The coverages that we provide: workers' comp, general liability, auto liability. We also do garage keepers, liquor liability sometimes, so there are some additional coverages that we supply. The mandatory coverage to join is workers' comp. You don't have to put your GL or auto in. That's completely up to you. We do have a captive called Epic that's for property that's available to you as well. And we do have Well Health and Partners Health that's for employee benefits. So there's multiple aspects, but they would be multiple captives. How the structure works is this is on the back end. On your day-to-day business, you have a guarantee cost from an A+ rated carrier, Old Republic. Nobody on the outside world is going to know that you have a captive. It's going to look like you have a guarantee cost policy. What we're doing is Spartan is reinsuring from 0 to 300,000 Old Republic for the first 300,000 of every claim. And then Old Republic goes $1 million statutory on the work comp, general liability and auto liability are $1 million, and the umbrella Palmer and Kay will have sitting on top of that guarantee cost policy. What we also include is basket and clash. So basket is if I'm an employee and I'm driving a company car and I hit a busload of attorneys, all of those attorneys are severely injured, I'm injured, and the car is totaled. That could be multiple claims individually, auto liability, 300, auto physical dam, 300, workers' comp, 300, but we basket that in so you have one claim. So we're capping the impact and minimizing that on the captive itself and reinsuring most of it away. Clash is if I'm a member and I am driving down the road and I hit another member. So we have 2 members in the same captive that got in an accident with each other. Well, instead of having the captive get impacted twice, we're combining that into one occurrence, and it's going to impact the captive as a whole once. This is very confusing slide. It is like the slide of arrows. It is not my favorite, but I do want to point out that the vendors that are in that 36.28%, you see Access Re, they provide $300,001 up to $1 million for the auto and GL. Old Republic, which is the fronting, that's the paper company, that is providing the statutory limits on the workers' comp and the basket and clash coverage. Spartan is the company that you would own. That's that captive. You see Gallagher Bassett, that's that third-party administrator. We like to do all of these unbundled programs because what happens, let's just say you don't like Gallagher Bassett. They're not handling the claims you want the way you want them to. Well, we can go to other members or other vendors. We don't have to stick with them. You see Old Republic, if you don't think they're releasing your policies fast enough, or you don't like the way they're handling certain things, we can go to different. We have AIG, CNA, Zurich, National Interstate. There's multiple different carriers that we can go to. But right now for Spartan, these are the carriers that have been with us for over 18 months. Gallagher Bassett will handle all your claims. Everything will be on an online system. We also have a claims person in-house. So if you have any issues with Gallagher Bassett, you have somebody to call immediately. And there's pretty much 2 people. You have Palmer and Kay, and then you have Captive Resources. And those two people will be going to bat for you, and then you will be looking online, talking directly with the claims adjuster, directly with them. Older public kind of is staying out of it unless it hits their layer. Then you see risk control. Also, Gallagher Bassett is included in that, but we also do 55 vendors. So people that are looking for drive cams that may be thinking about it, the members at Captive Resources, we have bundled it, and we've said, hey, how do you like this service? And it's literally called Drive Cam. And we've negotiated rates for all of the members. So if you want to have Drive Cam, well, once you join the Captive, you can get it at a discounted rate with them. And there's 55 different ones that we produce and give to you every single year as a reminder. All of this is just a support system. The one thing that you want to look at is that green dollar sign. That $36,000 goes to pay for all of those vendors on the right-hand side. But what really is important is that, 63 cents of every dollar is going into Spartan that you own. And what goes into Kensington's at management, they work and they help invest that money, and then it comes directly back to you once we close out those years. So let's do a sample member. Let's go through some numbers. This is an actual member of Spartan. You can see that their loss forecast is $247,000. That $247,000 is a loss pick. Like I said, Pinnacle and outside actuarial, we get all your information. Palmer and Kay collects it all. It's 5 years of your currently valued losses. We send it over to them. They give us a loss pick. Basically, it's their estimation of what you're going to have in claims for that year. And then we add on the operational cost. Again, that's 36.28. So the premium of $388,483 is their insurance cost for that year. AROs, assigned risk overburdens, state TRIA, and state surcharges, terrorism. You're paying it now. It happens when we back into the number on a guaranteed cost basis. So you see total pay-in for that year is $403,692. Again, that's all insurance costs, so you can write that off. That $300,000 retention that I mentioned earlier, it is broken out between an A fund and a B fund. The A fund pays the first $100,000 of any claim. So if you have a $300,000 claim, the first $100,000 comes out of the A. The B fund is for larger claims, risk sharing. So $200,000 of that $300,000 would be in that B fund layer. The B fund is the risk sharing layer. Like I mentioned earlier, we have to have a risk sharing because that identifies us as an insurance company. And everybody's risk sharing now, but you just don't get to pick and choose who you're risk sharing with. So you see that 247, how it's broken out. A fund 184,000, B fund 63,254. The actuaries cap every claim at 100,000 because that's a predictable layer, and it minimizes the impact on a severity claim. So in a captive, what we really want to focus on is those smaller claims, minimizing them and getting control over them. The larger claims, the members are there to help you out on. So when we go through a typical year, and I say typical average, for them, they had an average of 52,837 in claims under 100,000. So that could have been 10 or 20 different claims. So why we do this, and I don't know, simple math, no triangle math, you have 184,287, you deduct 52,837, you have 131,450 left over. You didn't have any large claims that year, so you still have your B fund. So at the end of the year, we're looking at 131,450, 63,254 in your B, and that's before risk sharing. On average, through all of our captives, it's anywhere between 5 and 7%. Estimated interest, that is coming from that captive investors fund, and that's over possibly anywhere between 3 and 5 years of 35,000. So when we say build equity from your insurance, this is what it looks like. 229,704 is sitting in there. And that's your estimated return. And when we talk about closing out years, that's the money that could be coming back to you personally. It doesn't have to go back into the company. It all depends. You could be very flexible. You can fractionalize it into multiple different buckets, but that's that equity that you can have within the captive. Now, what happens if you have $1 million claim? So this member didn't have $1 million claim, so I took one of their years of 32,512, and I threw in what happens if they had a massive claim, $1 million pop. Well, the captive is only responsible, my animation is a little off, so I'm just going to throw it all up there. The $1 million, we're only worried, you can see it on the right-hand side, for that first 300,000. 700,000 of that has been taken by Access Re and Old Republic. We don't have to worry about that. So when you think about this, you have 32,000 that you have in small claims and a $300,000 claim. So you had 184 in the A fund. You deduct the 32,000, but you also deduct the first 100,000 out of that $300,000 claim. So when you go back to the right, you see $200,000 balance. Your B fund is to pay for your large claim and to help others. So you use your B fund to deduct from that large claim. So you have 136,000 left. You have money left in your A fund. So we're going to use that to pay for your claims. So 51,000, $84,000 left. That's risk shared to all the members. So 84,000 is risk shared to everybody's B fund. So 30 other members are taking that 84,961. So the benefit of takeaway of this is majority, 700,000, was reinsured away. There's no additional premium for having a large claim. You're still gaining investment income. And then you're capping that claim on renewal at 100,000. So again, you're minimizing that. If that happened in conventional insurance, don't tell me you're not getting an increase. You know you're going to get an increase. This increase is going to be minimized because that $1 million claim is only 100,000 on your loss pick. Now, let's talk about how the captive is in an assessment position. Now, this assessment position, yes, there's additional premium onto it. However, it is protecting member to member. So let's just say for this year, you had $250,000 in claims, all below 100,000. So this could be, again, 20, 30, 40 different claims, but they all impacted that A fund there. The members aren't there to help you with your slip and falls, dings, dents, and bumps and bruises. They're there to help you with that $1 million claim, the back injury, the large accident, anything like that. That's kind of, a drunk driver hits one of your employees, driving a car. Somebody's texting and driving hits one of your employees. All of that, that's what the members are there, something that's out of your control. Smaller claims, you have more control over. So you can see in this scenario, it's like overdrawing from a bank account. You've overdrawn in this scenario from your A fund by $65,713. So what happens is you still have B fund left over before risk sharing. You still made investment income because you still have loss funds in there, but you have an A fund adjustment. So let's just say this was year one, you paid $403,000, but you have an assessment in year one. Let's just say year one's 2020. 2021, you pay 50% of that back. You're paying yourself back. There's no operational cost added on to this. There's just a federal excise tax. Well, it is paid quarterly because I guarantee those claims, those $250,000 worth of claims, are still open. We want to give you 3 years to close them out. So this number will fluctuate. But then you're going to pay 30% in 2022 and then 20% in 2023. It's a cash flow system. When we go back, the max assessment that you will ever have is an additional $184,287. So if you had $1 million worth of small claims, you would still only have to pay that 184 plus an additional 184. There's a max scenario, a max exposure in a captive to, again, protect you, but the members are there to help you out on any other large claim scenario. But we want to make sure that there's no additional. I mean, for you to hit double your max would be pretty extensive. There's no lump sum. This goes through everything that I just went through. We do have claims reviews every 6 months. So if you have an assessment, that also will be reviewed. This is just a clip of the investment. Again, Peter will be going to more in depth, but you will have to post collateral. So the collateral is, again, protection from member to member. If a member ended up going bankrupt and couldn't pay, their current claims, well, Spartan Insurance is responsible for that. Who owns it? You and all the other members. So what we do is we make sure we hold collateral. So if that member ever went bankrupt, we have cash on hold to pay for those claims so you don't have to as another member. We also have to capitalize the captive. This is a company that you own. We're also collateralizing Old Republic because that, again, on the outside world, they are the face of it. So technically anything that you say, hey, I want to close out this claim, Old Republic technically pays it and we pay them back. Your options are a letter of credit or cash. The equations behind the collateral is we need to build up to 2 times your A fund. Why? Because that's your max, remember, with the assessments. So what we do is we give you 3 years to do that, so 2/3 over 3 years. After that, you just have to maintain it. Maintain an average A over 3 years. So if your A fund drops down year over year over year, we will start releasing collateral, because if your A fund after your, after 3rd year, your A fund's $100,000. Well, the average A is maybe $125,000. So we will only need $250,000, but we have $368,000. We will release some back to you. So you can see that we give you time. And again, it doesn't have to be one way or the other. It could be a letter of credit or cash. And if it's cash, it gets invested into the captive investors fund. And you could post a letter of credit and then maybe 5 years down the road, you want to move to cash. It's completely flexible, up to you. This is also your money and also on your financial statements. So this isn't something that if you decide to leave the captive, it's your money. It still comes back to you, plus the investment income. There's no fees or penalties to leave the captive. You just have to wait. So if you were in the captive for 5 years, and let's just say you joined 2020, you want to leave in 2025, you'll have to wait till 2030 to get all of those 5 years back to you. Here are the formulas for the captive. So to get that premium, A plus B plus operation cost, 2 times your A plus your B plus operation cost is your expected max. 2/3 of your A over 3 years, your collateral. Everything is based off this core. That's why I said in the beginning, no matter what captive you go to, this is that core function. This is an example of a 5-year look back. You can see this member, 2015, 2016, 17, 18, 19. They paid a total, and it says captive premium, but it was actually guaranteed cost premium of 2.496 in premium. We break it out to say, all right, out of this, if you were in a captive, your loss funds would have been roughly about 1.5 of that 2.5. And then you drop down to the A fund, 1.1. Then you have 637 in your A fund layer. 2016, they have an assessment position. You see B fund, 387,000. They had B fund losses of 131. They actually caused risk sharing in 2016 of 53,000. But even though they have one bad year and they have assessment positions at the bottom, you see the investment income down there and final equity balance of 1.1. So this member, if they were in a captive that spent 2.5 in insurance premium, they would have had 1.1 coming back to them. Now, if you wanted to look at a net outside the assessments that they had to pay, they still would have had 990,000 coming back to them that they basically gave to the carrier. Now, best thing I could do is, if you're interested in the captive, I could do this right here, this sheet for you. I just need 5 years of premium and 5 years of losses. And then you could kind of see of where your equity balance would have been if you were in the captive. So now I'm going to introduce my partner, which is Peter Enyart, and he's the CPA that's on Spartan, and he will be talking about the investment side and the tax side.
Hello, thank you, Nicole. And again, my name's Peter Enyart, and I'm with Captive Resources. I am one of the finance consultants that work on the group captives here, including Spartan. And I'm going to introduce to everyone today a host of finance matters, including tax and accounting. But really, there's 3 things I want everyone to sort of focus on if there's any sort of key takeaways. The first is just understanding the structural, the structural setup of these group captives and how they work financially. I also want everyone to understand the tax consequences of getting into one of these captives. Unfortunately, there's this misconception that these are tax shelters, which is not the case. So I am going to explain how the tax consequences work. And then we're going to talk about some of the investment opportunities that the captives can invest in themselves. So a little bit more about me. I am a CPA. I worked in public accounting for a little while, then went into private accounting as a controller. Really missed helping clients and getting back out on the road. So now I am doing this consulting role, and I focus on the group captive structure. So let's just jump into it. I think to understand the structure financially of these group captives, it's important to understanding some of the accounting and disclosures that go around with the captives. So let's first start about the $36,000 investment. Nicole touched on that earlier. So let's explain a little bit more as to what that really means and what is it, right? So every member is going to pay in $36,000 into the group captive, and that represents their ownership into the captive. That ownership is broken into 2 shares. So every member gets these 2 shares. The first share is the common share. That's a $100 stated cost buy-in, and that represents and provides the rights and obligations to the insurance program. And it also provides the member the ability to have a vote. So no matter what size your business is relative to the captive, each business still maintains 1 vote. And I think that's important because it allows members to not feel like they're being overshadowed by maybe a larger member that's in the group. And it also provides the obligation to fulfill your insurance obligations, including compliance with security collateral and any other premium and assessment bills that might be due. And then there's the preferred share. And this is sort of the more exciting share, and I think kind of falls under this theme of building equity, because it's the preferred share that gets the access rights to all the dividends and profits that are earned by the captive. So remember when Nicole was talking about the 36.28% operating cost that goes into the premium, it's this remaining, call it 64%, that can build up, create equity, and also provide dividend rights for the future. So we're going to be going into that so you can see how that works. But it's also good to know that there are 2 separate shares. So you can keep 1 share with respect to the business that's being insured, but you can also transfer the second share to a trust or hold it in the owner's individual name. So there are planning opportunities that can be used to help make this structure most efficient and effective for you as a business owner. So let's talk about some of these other insurance concepts that were brought in. So again, the $36,000 of capital that would sit on the business or whoever the shareholders that are holding those shares as an asset, right? This is the investment into the captive. Then there's the insurance premiums and assessments paid, right? So this is just the ordinary cost of insurance. So this maintains a deductible business expense. So it's not self-insurance. And it's going to be broken out in operating costs and loss funding, like we talked about, operating costs being the 36% and the funding for your loss funds at 64%. So just kind of keep that in mind. And then there's the collateral, right? And collateral can be posted by either cash or posting a letter of credit. So if you put in cash into the captive to satisfy those collateral obligations, think of it like a security deposit. It's your money, but it's going to be sitting there in case you don't fulfill your other obligations with the captive, such as paying your premiums or assessments. But if you don't want to post cash, there are alternatives. There's the letter of credit option. So what you can do is you can get your bank to back your obligation. And what that would generally represent on your financial statement is just a disclosure because there's no funds transferred. But keep that in mind when we start talking about the captive investments, that only the cash that gets posted is eligible for investment, because with the letter of credit, there is no funds getting transferred to the captive. So that minimizes the ability for you as a member to have more funds invested in the captive investors fund. So we'll talk about that in a bit. But let's talk about distributions first, because that's really what makes the equity that can get generated in the captive valuable. So dollars are going to be distributed back to members based on the board votes of the captive. So remember, you are going to be a board member and an owner of the captive, so you can help determine by vote when these distributions are made. So what we're going to do annually is look at the available funds that have accumulated by underwriting year and look to see, well, what do the actuaries predict is still out there for exposure? And then the remaining funds we can distribute. It's really not more complicated than that. But we do need to make sure these policy periods are mature and well understood, so we know what sort of claim activity is occurring. So what we find is that in a general or typical year, 3 to 5 years after that underwriting period has ended, we will start to make distributions. So distributions in this case come back tax-free. And that's because the way the captive is structured is that earnings of the captive get flown through and back to the owners. So if anyone is familiar with the K1, I would say this is different, but it's by nature similar. So what's going to happen is that income that's earned from the captive will flow back to the members, and they will pay tax on that. And that's called subpart F income if we want to get technical. But ultimately what that does is then provide you the ability to receive a distribution, and those distributions come back tax-free. So you only pay tax once. There's no tax in the Cayman Islands. And so it is an effective structure from that regard, but not a tax shelter by any means. So here are the common tax forms. I'm really going to focus on one today, and that's the 5471. So I mentioned the K1 earlier. This is a similar type of form, but instead of relating to a domestic business, we're talking about a foreign business. So this is the form 5471, because these group captives, such as Spartan, are considered a foreign corporation that is domiciled in the Cayman Islands. So we'll see here, and this is just to kind of help understanding the timing of the reporting, is that Spartan's tax year end is April 30th. So that falls within, in this example, 4/30/2019 falls in the 2019 tax year. So we will have the forms and everything prepared before the end of the year, so that the members, especially those that are calendar year ends, have all their forms and documentation well before they need it when it comes time to their tax form prep. Next, I want to talk about investments, right? Because I think this is really the more exciting thing here, because if anyone has ever heard of the concept of float, here, let me just bring this up. Warren Buffett said it, I think, best. And what this means is this concept of float means that insurers are able to receive their premiums up front, and then they pay the claims later. So why that's important is that even if the captive has to use all of its funding, remember the 64% from the premium, even if it has to use all of the funding from the premium to pay losses, there's still this float time from when the money comes in that allows the captive to invest that money in additional investment vehicles. So we talked about the $36,000 of investment into the captive, and then once funding gets into the captive, then the captive can invest that further. So how do we do that? And we use the Captive Investors Fund. And the Captive Investors Fund is a mutual fund. It's domiciled in the Cayman Islands and is regulated by the Cayman Islands Monetary Authority. What's unique about this investment vehicle is that it's designed specifically for the captives that CRI is consulting on. So let's look at the objective of the investment fund, right? So the primary focus is to seek long-term growth and providing stability of capital, because ultimately those funds may be needed to pay for claims. So we do that first by making sure the portfolio stays well balanced in a diversified class of assets. We make sure all the assets are high quality and allows us to therefore preserve our capital and achieve favorable returns on behalf of the captive and ultimately the members. So if you go back to that 64% of the premium that goes in to your equity balance, while it's sitting there, it's also earning investment returns. So the benefits of the captive investment fund is that, first off, it's owned and controlled by the captives. So the control allows the members and the captive to determine exactly how these funds are invested. It's customized, so it's not just, off-the-shelf type mutual fund or ETF. It's very unique in how it's designed and allocated, and it provides strong collateral. So like each member has to stay collateralized with the captive, the captive itself also has to make sure it's staying strongly collateralized with our fronting partners, Old Republic, for instance. And it also helps us pool costs, keep costs low, and also provides liquidity for the captive. So these are the primary benefits of going through the Captive Investors Fund. So here's a little heat map showing how we allocate the funds and diversify. So fixed income represents the largest portion of the fund. It can be no less than 50%, including cash. Equities is about 40%, and alternative assets, such as real estate and hedge funds, are about 10%. Here are some of the returns and money we've seen through May. So as Nicole said, we're at 5.2 billion now, but as of May, these are what the numbers looked like. So 2020 was a tougher year. We had a tough first quarter, but it's recovering nicely. We're down 3.4%, and as I think many of us are aware, that's much less than a typical portfolio as of this year. And if you look at it over the long term, which is really how we're evaluating this fund, you can see this earns substantially more than some of the more conservative options that are there in other insurance vehicles. So again, another way to look at the asset allocation, you can see how equity is about 40% and fixed income plus the cash is over 50%. And so here's another way to look at some of the returns. If we had more time, I'd keep this up here longer. But the biggest sort of takeaway here is you can see the white cells represent the Captive Investors Fund, and it stays right there in the middle, which is where we want it. We want it to show positive returns, but we're not swinging for the fences because we need to make sure that when the funding and capital is needed to pay claims, that it's there. All right, any questions? I think we're going back to Scott or Nicole.
Do we have any questions in regards to anything that we went through today for Palmer and Kay, for Scott? I'm unable to see if they.
I have a question that's come in, Nicole, and I have three questions here. One is, can you place other insurance lines into the captive other than comp, GL, and auto?
So for the captives that we have on the casualty side, the only other coverages that we supply is the garage keepers or the liquor liability. But we do have Epic, which is a property captive, so your property can go into that one. And then we have two benefits captives for employee benefits, partner health and well health. But outside of that, we don't do anything outside of those coverages.
Okay, thank you. And another question here. Have you ever had a captive go bankrupt?
We have not. There has been other operations that have had that situation, but we've actually taken over 3 captives and have dissolved them because they were managed poorly. But here at Captive Resources, knocking on all the wood, we have not.
Awesome. And so the question, can members be voted out of a captive?
Yes. So every member, if just as if you were a member and somebody had caused risk sharing, was taking your money year over year over year, we have something called a watch list. So that watch list is based on finances of individual companies as well as risk sharing and loss control. The committees discuss that member. None of the members actually know who each other are on the equity statements. Everybody has what I would say is like a social security number. It's a secret number that you and your broker and me would know. Everybody else would be oblivious to it. But if you did cause risk sharing year over year over year, you didn't participate, you didn't go to the risk control workshops, you didn't give us kind of a plan of action to address this, the members would probably vote you out. Now I'm on another captive that's got 197 members. They've been around for 25 years. And they have not voted somebody off in the past 15 years. So it is rare, but it can happen. And if you are voted off again, that money is still yours. There's no penalty, even if you decide to leave or if you're voted off.
How many, this is just a question I have thought of, how many captive members, kind of come and go in and out of a captive scenario?
So at whole captive resources, our retention ratio is 98.8%. So it's pretty rare that they come and go. We've seen actually a lot of the ones that left in the past are really trying to come back. And I think that's just because the market's hardening, and especially if you have any kind of fleet.
Mm-hmm.
It's rare. We do see a lot of the people that do leave is, private equity comes in, buys them out. They don't want to hold all their equity up into a captive. They're going to want to be there for 5 years and get out.
Right.
Bankruptcy may happen, or it's just a sold. They just want to sell the company.
Mm-hmm.
It is, you can do I've seen companies add in the shares to the captive to that sale. So they're selling the company and they're like, oh, but we also own shares into this Spartan Insurance company. I'll add that into the sale. And you can get Deloitte to do a shareholders evaluation and get the cost of those shares and the equity within the captive. So I've seen people do that, or I've seen them sell the company but keep their shares within the captive as more retirement fund for themselves.
I've got a couple of other questions that have come in. One is how many members are actually in Spartan right now?
So there's 30 members in Spartan right now.
Okay, and then I think there was a question here as to whether, let's see, when do you close out Spartan that it becomes too big? So how big does a captive normally get before you close it out and start another one?
So that's a good question. Spartan was started again last year, and that was due to another captive getting too large, and they were at 197 members. And that was the members themselves. So what we do, kind of the evolution of a captive, is to minimize the number of members coming in, but continue getting premium size. You increase your minimum premium. So that way you're still building up your premium size, but you're not building up the number of people in the captive. So there is an evolution for all of our captives. And the best part is this is a prototype 101, right? We have, 41 other captives within captive resources. On average, what we've seen is once they get close to 200, they slow down significantly in bringing up their captive retention, bringing up their minimum premium. We actually have one captive here, and it is our largest. I think they have 495 members. They've actually are referral only, and they've been referral only for the past 5 years. So again, there's always these extra steps till we get a certain size. It's solely based on the members. So it's your decision as the owners. We bring you the data. We tell you what we're seeing. We go through underwriting with the underwriting committee and the executive committee more in depth. And then the underwriting chair and the executive committee present it to the members to say, hey, this is our submission flow. This is what we're seeing. If we want to slow down, this is how we can slow down. And the members give their opinions, but I also go to all the other captives and say, hey, what were your steps? What were your ladders? And I would like to bring that to Spartan to share. And then you decide as the owner.
Awesome. I got a couple other questions here. Is trucking and rigging company too hazardous for Spartan?
So we have a lot of trucking. Spartan would probably not be the home for that. We do have Wheels and Gibraltar that are more into that could probably do the rigging as well as Titan. Some heavier, again, that's that homogeneous, that's a little bit too high hazard for the heteros.
Okay. And the only other question that I see here is, does the captive provide any support for their members regarding safety training?
Tons. So 1% of that 36.28 is for loss control. So when you join the captive, you'll get a risk assessment. So it's called an RCA. And you're kind of scored, hey, this is what you're doing, this is what you could do better. And it doesn't have effect on your premium, it's just there to help guide you. And after that, we do 2 risk control workshops a year in the US. And those risk control workshops are for you to send your, going back to trucking, your fleet manager, if you have warehouse manager, you have a safety director, you have an HR, whatever you have, I would send them to go to that. And they actually get to intermix with a bunch of other, all the other Spartan members, and they sit round table. We have speakers, we have everybody that kind of sits around and shares information. Distracted driving is a big thing with anybody that has a fleet. Same with if you have a forklift, how are you, making sure they're not on their cell phone. All of this is discussed, hiring. It's really hard to find people these days, especially in the trade schools. They're just not getting enough people. And so that is all discussed at the risk control workshop. You will be assigned a risk assessor, so he will be there to help you out. But that 1% is there to help pay for the risk control workshops. And if there's anything left over, which you'll be notified, that's for you to use to bump up your loss control. And, again, the risk control assessments, the phone call, we have an in-house person. Currently, he's our chief risk officer for all of CRI that's on Spartan. He's there to say, hey, this is what you should be doing. If you need help, give me a call. We can talk it through. So being in a captive may be a little bit additional work in the beginning, but it is there to help change the culture of your company, to be more conscious of what's going on. To help, lower the losses, and we can lower our insurance premium. And going back to Peter mentioned, that preferred share could be going to, trust funds. It could go to an IRA. It could go into whatever you want to set up for yourself. But remember, it could be fractionalized. So a lot of the companies that are in the captives actually put 10% aside for employees. So they get their employees involved and saying, hey, if there's a claim, now you're not just taking money out of our pockets, you're taking money out of your own pocket. So there's a lot to do. We always say defense wins championships. I play defense, though. That's the main point in a captive. Defense is loss control and claims handling. And that's what we want to make sure our defense is up and it's strong.
That's awesome. I don't see any other questions. It looks as though that we're at the top of the hour. So we got through a lot of great information within the hour, which is terrific. Thank you very much, Nicole, Peter from Captive Resources. You did an awesome job as always. It's always fun to work together. Thank you to our audience. I really appreciate your consideration and your participation today. Really appreciate the questions. They were good ones. And so thank you for that. And with that, if there are no other questions, and I don't see any, I think we will adjourn on time. And thank you so much. Look forward to seeing you on our next webinar.